I want to talk about a different way to invest. My name is Chris Vermeulen from the Technical Traders. I take fundamentals and throw them out the window. I take pretty much economic data, throw it out the window, and I follow price, because that's the only thing that we get paid as investors is follow the money, follow the price. It doesn't matter how good a stock or company is doing. The reality is if the price is going down, you don't really want to hold it. And I'm also going to touch on what the gold energy, and the rest of the market is telling us with some economic data. So really quick here, I am not a registered financial advisor, so this is for informational and educational purposes only. All right, a little bit about myself. I'm from Collingwood, just north of Toronto here in Canada, married 25 years. I have 2 kids. I've been investing since I was 16 years old. I live and breathe the markets, and this is pretty much all I do. I lost a lot of money in the tech bubble with fundamental trading, buying shares, selling covered calls. I have done futures and day trading. I've done all the different styles, and I've come to a full circle of what works best to grow and protect your capital with the best return and the lowest potential risk that you can get here. So there's a few high-risk strategies that have very low return, and most of us end up having these, and I'm going to touch on and kind of debunk all 3 of these and why they're so dangerous. So eventually we're going to come into one of these. These are one of the bear markets. This is the S&P 500 index. I'm covering the US markets here, but we had the 2000 tech bubble, dropped 50%. We had the 2008 financial crisis, and it's just a matter of time before one of these happens again. Now, does anybody know what a drawdown is? Does anybody know so there's a price drawdown, right? That's what you're talking about? Does anybody know what the other type of drawdown there is? There's 2 types. Time is actually the second drawdown. So here's the problem with a bear market. If you lose money, it's not that big of a deal because we can always make it back. And I'm going to show you how we can compound our growth during the market decline, how we can get it back on the climb up, compound it on the way down again, reinvest it near the top or at the bottom to go up to the top. But what we can't get back is the 12 years wasted from investors. During the tech bubble, this was 16 years, a lot of time, a lot of stress. I'm going to show you how we can make the most out of every sell-off, every rally, and every minute of our time so we don't waste years of no return. So if you're struggling, if you're having problems, you're missing rallies because you're worried about the stock market topping, if you're busy and you just need a strategy to follow, a simple ETF strategy, and if you think holding stocks during a bear market just doesn't feel right, when everything is going down, why are you holding it? I'm going to be able to help you here triple your returns in the average buy and hold portfolio with a fraction of the risk. So how do we go about doing this? Well, I'm going to show you. I'm a waterman. I love the water. I love kiteboarding, spearfishing, swimming, you name it. I live on the water. The best analogy for the stock market or most asset classes, think of the ocean tide. What happens to a boat when the tide goes up? All boats go up. When the tide goes down, all stocks go down. There's a time to be invested in stocks. There's a time not to be invested in stocks. And when we look at the stock market, when it's going up, that's when we want to be active in individual stocks, sectors, indexes, things like that. And during a time going down, we don't want to hold it. Now, if we were to zoom in a little bit, this is the S&P 500 daily chart. And if you're walking down a beach in Florida and you look at surfers out past the break, they're floating out there. What are they doing? They're waiting for a set of waves to roll through. Now, the stock market has 5 to 12 waves that roll through every year, just like the ocean. You have these beautiful sets that come. You see them coming. You can hop on the asset class that you understand, it fits your risk criteria. You hop on the wave, you ride it up. The nice thing about jumping on a wave that is stronger than normal is you can also tell when it's starting to weaken. So we can lock in profits, move our stops up, eventually get out, wait for another wave to prove itself because you never know which correction is going to turn into a crash. This was the 2022 bear market. You can see here there's not much opportunity to the upside. All the opportunity is actually when the bars go red. So what the best things to do is to move to a different asset as the market starts to go down. It could be bonds, it could be a currency, it could be a cash position, it could be an inverse ETF. And understanding when to be long or net short the market is the key to not having a roller coaster ride as you go through everything. So danger number 1, the buy and hold portfolio. This is what most people suffer from and don't understand the danger that it provides. If we take a look at the top chart again, this is the S&P 500 weekly chart, and you can see if you were to invest $100,000 on that first chart, See if I can draw here. I don't know if you can see that. But anyways, if you were to invest after COVID $100,000 and you have a bull market signal, the technicals, the analysis, the money flow says, hey, there's a new bull market, let's get into equities. You ride it up and the market moved about 41%. So you now have $141,000. Our strategy now says, hey, we've turned into a net seller of the stock market. Let's get out. Let's move to a different asset, which at this point, the US dollar rallied 18% during that decline. And we avoided stocks. And then we reinvest it when the new bull market starts in equities, and we ride it up for 41% or 44, which is where we're at now. And you've more than doubled your money with a very simple strategy. Bull market, bear market, you're either in it or you're not, and you're only holding it when it's in favor. Versus the bottom here, if you take a look, that's the Vanguard 60/40 portfolio. It is a hell of a roller coaster ride. You're wealthy, you give it all back, you go negative, and then you end up with a really crappy return, and that's because of diversification. So buy and hold is volatile. If we take a look at diversification, this is a noisy chart. Let's focus one chart at a time. The very top one is the stock market. This is the most recent signal in the markets. Top is the QQQ. We were naturally in the bottom one, which is TLT bonds. Bonds had a move up. We got out of bonds, and our strategy said move into stocks. The money is flowing into the stock market. That is the wave, the tidal wave coming. We moved into the equities market. It rallied 3%, hit a target, hit our 10% target, and then the market changed trends, and our strategy said get out at 6.5 for the balance. Now, if we were to hold the bond portfolio on the bottom, you're down about 12.5%. If you take a look at that middle chart, that 60/40 portfolio there, that is the dangers of diversification. You end up having these great gains in the stock market, but you're diversified, which means half of your portfolio is going up, the other half is going down, and of course you take a big loss. And so you're now taking a loss. The problem with diversification is your winners are killed by your losers, and you end up with a very narrow net profit. So you don't really want diversification. You want to own assets going up, ditch them, move to another asset when the one you're in starts to go down. So danger number 2 is falling in love with stocks. This is a big stock show. I'm sure a lot of people are falling in love with stocks, but the reality is there's a time to own them and a time not to own them, and that's what I want to kind of touch on here. Who here own marijuana stocks or still holds some? They were gold stocks, they turned into marijuana stocks, and now they're not even listed, a lot of them that I had some back in the day. This is the problem with falling in love with stocks. You love the idea, it never really comes back from the dead. The ARC ETF, everybody got into the ARC ETF after COVID, big trades, everybody was a hero, and then here you are getting chewed up, spit out later through this cycle. Now the stock market has 4 stages, 4 cycles here that go through. Everybody wants a stage 2, which is a bull market phase, the one going up. Problem is everybody builds a strategy and thinks and trades for that strategy for that stage, but there's 3 other stages. Every stage requires a different strategy. Typically, a different set of assets will actually perform better in those other stages. So this is why most people struggle to do well falling in love with stocks. There was a movie that came out and they showed that 9% of stocks in the SP 500 account for almost all of the gains. So you've got like a very small chance of picking the one stock that does really well. The dangers of dividends. So this one always kind of seems to throw people for a loop. Dividend stocks is what most investors own. Most people in the stock market are 45 plus. They're all told get into the big chips, the big blue chips that pay dividends. They got big premiums and payouts, but they're very dangerous. And the reason is because most of the money of the investors are in the same stocks. And if we take a look at the SP 500 at the top, in the last 2 weeks, it's down about 4.5%. If we take a look at the dividend stock, the dividend ETF, it's down about twice as much. And this is because the same people who all invest in dividend stocks, when they all get nervous, they all sell their stocks. They're all the same stocks. So you take a lot more risk with dividend stocks. All to get an extra % or 2 yield, you're pretty much doubling your risk. If you look at COVID crash, the top chart, the SP 500 fell 35%. That shook everybody to their core. Poor retirees almost got their account cut in half with dividend stocks. Dividend stocks have terrible performance. They have very little upside, but they have way more downside risk. And this is like one of the biggest things when the markets crash and hit, retirees are like, why am I getting slaughtered here? And it's simply because you're all panicking, you're all selling the same stocks, and they're getting hit way more than the stock market. So I want to talk about asset revesting in this strategy. I actually wrote a book on it called Asset Revesting, and it's an adaptive compounding strategy that shows how to get into specific assets at certain times, how to reinvest that money into only assets rising in value. So if we were to take a look at the growth of the asset revesting strategy, which is the thick line, versus the ARC ETF. If you're an active trader, an aggressive trader, you're in the ARC ETF, the thin blue line is what you experience in your account. You experience emotionally. It is very volatile, very scary. Obviously, you can see it fell 81%. Most people don't like about a 10 or 8 or 10% drop. 81% does a lot of damage. If we take a look at the dividend, people who own dividend stocks as most of their portfolio, you can see during chaos and trend directions, asset revesting strategies keeps rotating into a different asset and reinvesting that and compounding its growth in a very slow way. It's a bunch of first, second base hits, but it's compounding and we're not holding things going down. Versus dividends, obviously you have a heck of a roller coaster ride. You have all the downside and almost no real upside in participation. So if you were to compare a strategy where we only hold assets going up, the top thick line is this ACS strategy, and we have the green line, which is the 60-40 portfolio. We have the SP 500 above that, and the top one is the NASDAQ. Most people would die to outperform or match the NASDAQ since the 2008 market top. It is pretty tough to beat, but we have been able to do that because we compound. As Albert Einstein says, compounding is the most powerful force in the universe, and if you can follow money trends, which is not that difficult when you have the right tools, the right know-how. When a trend changes, you either get into it or you get out of it, depending on what side you're on, and you just keep reinvesting that money, and it compounds and compounds, slow and steady. It's all about consistency. That's what I try to do. This whole strategy is what I've been trading since 2001. I only trade it with my own money, and I share it with people who follow my work, and you just copy my portfolio. That's what I do. So if we take a look and just compare the strategies, we've got the NASDAQ at the bottom up 800+% since 2008. We've got the ACS strategy. This is where the value is. Everybody wants growth, I get that, but to me, the biggest value, I have blown up 3 accounts when I was a lot younger, and I've been through a bankruptcy, grew up through one, so I'm very risk adverse. I'm a pilot. I'm all about checklists. I'm a quasi-engineer, so I love systems. I love rules. This is what gets me excited is the drawdown for the ACS strategy. The top right green circle is you have consistency with your retirement. You're not going to wake up and lose 50% of your account, 20%. You're not going to have to worry about financial resets because we can take control and we can act on chaos. In fact, volatility becomes our friend. I'm going to show you how we do that by rotating through an asset hierarchy. So how do we do this? Well, I follow a very simple hierarchy of what to own and what not to own. So here is the top, the SP 500, which is the stock index. Could be the SP 500, could be the NASDAQ, or both. And the top one is the most volatile. We generally want to own the highest asset on the hierarchy because it has the most volatility, which it has the most opportunity for us to make money. But if the stock market isn't favorable, then we want to move down to a different asset. It could be TLT, which is a long-term bond fund. It could be a US dollar index or the inverse US dollar index, so it doesn't matter which way the dollar is going. We can move into something very slow. As you can see down the right-hand side, the volatility drops. So as the markets are crazy, getting crazier, we're going to slower and slower things. And then, of course, we go into BIL, which is just a cash position. We earn daily interest, get a monthly dividend check, and we can actually sleep at night when nothing meets our criteria, which happens quite a bit. Believe it or not, about 30 to 40% of the time of the year, we're in a cash position waiting for a set of waves. So half the crap that happens in the markets, the wildness, the randomness, we're not even around to exposure. We're sitting on the side collecting interest, waiting for another wave to surf and ride and push our accounts to new all-time highs. So this is what it looks like when you apply this strategy. So the top chart is the SP 500. And the strategy in the markets were saying, hey, get out. There's money flow has gone negative. The technicals have broken down. We get out of the stock market. And at that time, TLT, which is the bond market, it was doing very well. We moved in, it rallied 19% in 9 days. It gapped above our 15% target. We got filled at 19% at the peak. We moved out of it and we moved into Bill, which is a cash position. And this is during COVID where no one knew what was going on. It was complete chaos. And we were able to sit in cash, richer than we'd ever been, and just deal with our life, our emotions, family, all of that stuff. And then a few weeks later, or a month or so later, we got another signal to get back into the stock market, and we rode it up for another huge move. And we got to buy it back at a 13% discount. So this is how we just rotate from one asset to the next. It's not rocket science. It is not difficult, and it's not that emotional because we're getting out of things before they get ugly. And we can identify when waves and trends are moving fast, how strong they are, the underflow of the current. We can identify all this through a lot of different analysis, cycles, money flows, sentiment, different asset classes, what they're doing, and how much money is flowing into various assets. So this is the difference between the buy and hope strategy or the buy and hold strategy. Say you had $1 million, you withdraw 50 grand a year to subsidize some fun time. This is the last 10 years, well, it's a couple years old now, but after that, you've got about $1 million left. It's not bad, you treaded water, you took out 500K, but everything now costs 3 times as much, so it's not really that good. Versus an asset revesting strategy where it doesn't matter if the price is going up, we can make money. If it's going sideways, we're in a different asset going up. And if the market's falling, we're in a different asset going up. So we can take advantage of all market stages. You can see there's a dramatic difference in terms of volatility. We don't have big losses. We're compounding our growth, and it adds up extremely fast. And this is what I do with about 3,000 investors around the world, 130 different countries. This is what we do. This is what I do with my money. I share it. And my whole vision, my whole goal of this book, of writing it last year, is eventually we are going to have another financial crisis. And my goal is to try and help and protect as many people as possible, because the markets are good at one thing, hurting the majority of people. And I believe right now there's more people close to retirement or more people retired than ever before. And the next financial crisis is going to kind of destroy everything. So in a nutshell, because we have very limited time here, the stock market cycle, usually precious metals do very well. We see gold do well. We see energy stocks do very well just before a major market peak. Gold has got the same characteristics that it had back before the lower one, which is the 2008 financial crisis. The multi-year sideways pause we just had in gold where stocks were rallying, real estate was rallying. No one wanted gold. They all wanted to get in stocks and real estate. Well, everybody now is worried about the housing bubble, the stock market bubble, currencies, wars, and they don't want to just liquidate because if they don't want to hold stocks because when they burst, you're going to lose money. Same with real estate. And as the man on here before was talking about, gold is a great spot, or a couple of speakers ago, it allows you to get out of the financial system. If you put your money in a bank, you might go bankrupt, and physical gold is where investors are going. Energy stocks are about to crash as well. And if we take a look at what unemployment is doing, every time we see unemployment turn up, eventually we kick into a recession. I believe real estate is going to be the tipping point for the majority of people to close their wallets. Almost everybody here probably owns a home. Housing supply is going up. No one is closing sales. We have very low pending sales. Supply is building. And nobody wants to lower their price for their homes. And a lot of it has to do with real estate, especially in Canada. Our real estate rates, our mortgages come up 3-5 years, and it's about to get hit. A lot of people aren't going to be able to afford their homes. Home prices had this huge pop. This is a COVID pop. I call it a news-driven move. It is going to fizzle out. Usually what happens on news and emotions will get wiped out. So we have a lot of downside in the housing market. This year, I think, is going to be a bloodbath when it comes to that. So that is kind of it in a nutshell. I share my trades. There's 5 to 12 trades a year. I share it in a service. If you want to copy what I do, we have a great community of investors. We all chat. We've got a community. And there's a whole lot here, but time's limited. You can talk to me after if you want. Hopefully you got a little bit of insight there. Appreciate it.